Hello everyone, I am Trupti Pandya and today I will be teaching you Element of Account Standard 12 Part 2 Chapter 4 Analysis of a Financial Statement. Students, in previous lecture we already completed up to third chapter Company Final Account. Now, today let us start the analysis of a financial statement. First of all, introduction. Business and non-business enterprise undertakes financial transactions. These financial transactions are recorded as per rules and principles of accounting. These financial transactions pass through different stages of accounting. The commencement of this stage is from journal entry. At the end of this stage, final accounts are prepared. We have undertaken that study in 11th standard in his regard. In previous chapter, we have studied in final account of a company. The component of final accounts are trading account, profit and loss account, which is also known as the income statement, and balance sheet. These three are financial statements. Besides, cash flow statement and fund flow statement are included in financial statements. These financial statements disclose the result of financial transactions of a particular period of a time. As an example, what is the amount of a gross profit? What is the amount of a net profit? What is the amount of a non-current liability? This kind of information can be ascertained from them. Financial statements represent historical information. This financial statement represent result of a financial transactions of accounting period. In brief, profit and loss account discloses result of a business enterprise and balance sheet disclose financial status of the business. Cash flow statement related discussion is undertaken in subsequent chapter. Cash flow statement also discloses the result of a difference between cash flow inflow and cash outflow. Cash inflow means cash comes in our business unit and cash outflow means cash goes from our business unit of financial activities of a business. Financial statement disclose what is the result of a business but do not disclose why this result. Factors responsible to such a result cannot be ascertained. What type of relationship is there between different components of a financial statement also cannot be ascertained from financial statements. However, the objective of financial statements are predetermined and for respective objectives financial statements are prepared. First of all, sale of a company is rupees 80,000. Closing stock is rupees 20,000. Opening stock is rupees 10,000. Purchase is rupees 50,000. Consequently, gross profit of the company will be 40,000. The computations is shown in the page number here. Trading account, opening stock 10,000, purchase 50,000, sales 80,000, closing stock 10,000, 20,000. 80 and 20, 1 lakh. 1 lakh minus 60, then 40,000 is the gross profit. Here gross profit is the result of purchase sales transaction. Trading account disclose information about result of 40,000. These transactions can be represented in the following form. The information presented in this form can be interpreted. The process of interpretation and analysis is given below. Sale 80,000. Less cost of goods sold, opening stock 10,000 plus purchase 50,000, 60,000 minus closing stock 20,000. 60 minus 20 outer column 40,000. So 80,000 is a sales and gross profit is a 40,000. So there is a profit of rupees 40,000 because of goods 40,000 are sold, 80,000, 40,000 is a result. But the factor of this result creation are sales, closing stock, purchase and opening stock. Even a small change in one factor leads to the change in result. As example, in the above mentioned problem, if the value of closing stock is 24,000 instead of 20,000, the cost of goods sold will be 36,000 instead of 40,000. Consequently, gross profit will be 44,000 instead of 40,000. So, through analysis, the information pertaining to affecting factor is ascertainable. Second, the creation of gross profit is from sales. Therefore, the proportion of gross profit is sale will be 40,000 gross profit upon all 80,000 sales into 100 is equal to 50%. It means gross profit has a relation with sales. The gross profit increase due to the increase in sales if other factor remain constant. Hence, the quantum of gross profit would increase. In case of above mentioned illustration, if a sale is rupees 1 lakh and there is no change in other factor, The cost of goods sold remains rupees 40,000. This will give gross profit of rupees 60,000. So there is a direct effect of change in sales on gross profit. This kind of information can be availed through analysis. How the gross profit of rupees 40,000 is earned? What is the proportion of gross profit to sales? This is ascertained through the interpretations of information disclosed in financial statement or by presenting the result in a different manner. This process of interpretation is known as an analysis. Thus, the interpretation of information or a result given in a financial statement is known as analysis. Analysis of financial statement. Which tool are used? Which procedure is used for analysis? To whom is it is useful? What are its objectives? Answer pertaining to these questions are to be studied in this chapter. In the previous chapter, we have studied the financial statement of company. In the 11th standard also the study of entities is done in the chapter 5 of part 2. Financial account. So we do not discuss it again here. The information in a content of financial statement analysis as follows. First, meaning of financial statements. Business or non-business entities maintain their account. For preparation of these accounts, rules, principles, traditions and assumptions of accounting are considered. Financial statements are those statements which provide the result of a different financial aspect of the entity. Financial statements are an organized report which disclose the detailed financial condition of the business entity. Third one, objectives and types of a financial statement. First, objective. Different financial statements are prepared under the accounting system. Every financial statement has its own independent existence and use. Financial statements like an income statement, balance sheet and cash flow statements are prepared. There are some other financial statements also. They are not included in the syllabus. Each financial statement is prepared with a specific purpose. Its explanation in brief is as follows. First, to know the profit or loss of the business entity. Business entity undertakes revenue activities throughout the year. These activities are of two types, receipt and payment. If receipt are more than the payment, difference is known as a profit. Receipt are more than payment, difference is known as a profit. If payment are more than receipt, difference is known as a loss. It's if income is more than the payment, then it is a profit. And if there is a payment is more than income, then it is a loss. The information for such a profit or loss is available from the prescribed financial statement. This statement is also called income statement. Therefore, the first objective of the financial statement is to ascertain the profit or loss of the business. Second, to know the financial position of the business entity. The financial position of the business entity is determined on the basis of a difference of asset and liabilities. When the value of asset are more than liability, it is called the good financial position. When the value of asset is less than liability, it is called the weak financial position. This information is available from the prescribed statement, which is known as a balance sheet. The second objective of a preparation of a financial statement is to know financial position. Third one, to know the cash position of the business entity. The business undertakes the transactions of cash, receipt and payment during the year. The information about different sources of cash and application of cash is available from the prescribed statement. This statement is known as a cash flow statement. The third objective of preparing the financial statement is know the cash inflow and outflow of the business. Means there is any expenditure or income is there. In brief, financial statement and objective. Income statement, profit and loss account. To know the profit or loss of any specific period of the business entity, this statement is prepared. Balance sheet. To know the financial position on a specific day of the business, this statement is prepared. Cash flow statement. to know the cash inflow and outflow of any specific period of the business entity, this statement is prepared. Now, fourth objective, significance of a financial statement. The information disclosed in the financial statement is useful to existing and potential stakeholders. The financial statements are prepared to satisfy the different type of requirement of a management, existing and potential investors, fund providers, short-term creditors, employees, customers, governments, and other different agencies. The financial statements are important for these stakeholders, but the analysis of a financial statements accelerates and the significance of these statements. Meaning of financial statement. Financial analysis. The objective of preparing the financial statement are predetermined. Financial statements represent information and results, but after preparation of financial statements, they are rearranged in such a way that they become comparable. The different stakeholders take their decisions on the basis of financial statements, which are prepared in comparable form. This entire process is known as analysis. Type of financial analysis. Financial analysis done for internal and external purpose. This can be done in the horizontal form, vertical form, for short term and for long term. Discussion pertaining to this is as follows. We can present different type of financial analysis on the basis of stakeholders, external analysis, internal analysis, horizontal, vertical form, horizontal analysis, vertical analysis, on the basis of duration, long-term analysis, short-term analysis, on the basis of stakeholders. Financial statement of a business entity are used by various stakeholders. These stakeholders can be categorized into two categories: external party, internal party. External analysis. When published accounts like income statement, balance sheet, report of the auditor or directors are analyzed by external parties like potential investor, financial institutions, government agencies, credit rating agencies, researchers, etc. for their investment related decision or for any other decision, it is known as external analysis. If internal analysis is there, then the management of the business take their decision from accounts prepared by them. The base of this decision is analysis. When financial statements are analyzed by the management for their decision is known as internal analysis. The information available for this kind of analysis is accurate and elaborate, horizontal or vertical form. This kind of analysis can be done in two ways, in the horizontal form and in the vertical form. Horizontal analysis. Financial statements are prepared every year. The comparison of financial statement of different years is known as a horizontal analysis. This analysis is done for long-term planning. This analysis is useful to know the current trend. This analysis is known as a time series analysis. 2013 statement of income, statement of profit and loss, balance sheet, a statement of a cash flow 2016 and 17. Base year, and here statement of cash flow A and B is there. From the figure above, under A-type analysis, year 2013 can be compared with 2014 and year 2014 with 2015. Performance of each current year can be compared with its previous year. In the same manner, under B-type analysis, the year 2013 is treated as the base year and the performance of each subsequent year is comparable with the base year 2013. Both the above mentioned types of analysis are horizontal analysis. As compared to 2013, whether the profit of 2014 increased or decreased, whether assets are increased or decreased. This kind of trend can also be checked. The comparison of the statement of one year with the other known as a horizontal analysis. Now, vertical analysis. This kind of analysis is used to compare financial statement of one year. This analysis is used to compare the performance of a different units or a department of one year with the help of a different predetermined ratios. Financial statement of a different unit for the year 2017. Statement of income, balance sheet, statement of cash flow. Statement of income, balance sheet, statement of cash flow. Statement of income, balance sheet, statement of cash flow. Company X, Y and Z. The comparative analysis for 1 year among different unit of different financial statements can be called as a vertical analysis. Now, on the basis of a duration, one significant concept of accounting is going concern. As per this concept, the existence of a business entity is permanent. While preparing the account, the concept of periodicity is also considered. It is generally of 12 months. We have acquired information about this in 11th standard chapter number 6 of part 2. The analysis of accounting of a business can be done for short term and long term. Its explanation is as follows. First, long term analysis. Many stakeholders like a debenture holder, financial institution, potential investors undertake long-term analysis of financial statements before investing their funds in the corporate form of a business. For this analysis, information of more than 1 year is needed. Under this analysis, the stakeholders determine the present and future long-term solvency, profitability, liquidity, and efficiency of the borrowers. In brief, under long-term analysis of evaluation of above mentioned dimensions is done with the help of a financial statement of more than 1 year. Short-term analysis. This kind of analysis is used to measure short-term solvency or liquidity of the business entity. This kind of analysis is done by the short-term lenders as well as the suppliers of raw materials. As discussed above, the analysis of a financial statement is done in different ways for different purposes. For analysis of a financial statement of 1 year or more than 1 year are considered. On the basis of analysis, different stakeholders make the rational decision. Now we will study the objective of the financial statements of analysis. So this way, all the type of analysis are there, short term, long term, and there are on the basis of duration and the basis of their vertical analysis, horizontal analysis, long term analysis, short term analysis. This way we completed all these things. Thank you very much for this.